Hello guys, I'm Vijay and I've been a value investor for over 10 years and I'll be talking about investing and trading. I'm going to talk about something very interesting today. Investing versus trading. Most people start with trading and graduate into becoming an investor. I'm going to tell you why that happens. At the end of this video, if you decide that trading is the best option for you, then I'll tell you two strategies. These two strategies would make it very efficient and reduce your risk profile. In trading, reducing your risk profile makes a lot of difference. So don't forget to look at those two strategies and let me know what you do and what you prefer when you start trading. Also, don't forget to put your trading strategy in the comment section below. If you have a trading strategy, put that in the comment section below so that it can help everyone. But now, let's start with investing. Investing is the best option for over 99% of retail participants. If you are a retail investor who just has started the journey in stock market, then think about investment as your first step, because that is much more safer if you understand that you are investing in a company that you know. It would be much safer if you invest in a company that you understand very well. Thereby, the risk is mitigated and your investment would be at a much lower risk profile. And investment need not be a day job for you. You don't need to work 24/7 with investment, but if you choose to be a trader, you need to consider that to be an important part of your day's job. Since you don't need to spend a lot of time for investment as part of your daily routine, a lot of people can be an investor, and I would believe they should be an investor. So it's going to be helpful for 99% of retail participants. However, trading has to be a full-time job for most people if you want to have that as your primary source of income. Because if you don't use it as a primary source of income, it doesn't work like investment to compound over time, because your activity is what drives the underlying profit. In case of investing, once you are able to pick and monitor at regular intervals, compounding of time makes all the difference. Time acts as a variable in the compounding process, thereby giving you the returns that you desire. However, for trading, that's not possible. Your activity and your inputs determine the output. So if you think trading is for you, if you are that 1% of the retail participants who can efficiently trade, then you need to understand the risks associated with trading, and you need to see how you can mitigate those risks and be able to be an effective trader. So what is the problem with trading? If you buy a stock for trading and think that it can either go up or go down, so you have a 50% probability of winning, then it's a speculation. And there is a problem here. If you are speculating, things may not work out really well for you. You cannot predict the market, and you don't have a statistical edge because you cannot have any sort of control in the market, legally of course. If you go to a casino, and you would have heard about a phrase, the house always wins, I'll tell you how. Look at the wheel there. So you have three colors, right? Red, black and green. The green part is the statistical edge that the casino uses. It controls the market, because you can either bet on the red or the black, not the green. And they have some amount of statistical edge by introducing an option where the player cannot win. That statistical edge may not help the casino in the short term, because you might win 2 times in a row, maybe even 3 times in a row. But if you keep playing again and again and again, The statistical edge takes care of protecting the casino and makes sure the casino always wins. Similarly, if you keep trading again and again and again, then you would lose in the long term if you speculate and if you don't have a statistical edge. If you think the probability of winning is 50-50, then you would lose in the long term. Because if you lose some money today, it would take more money to recoup to the same level. If you lose 10%, then what remains cannot be pumped up to the same value with 10% gain. That's the problem. You have 100 rupees, you lose 10%, it goes to 90 rupees. And at 90 rupees, if you even have a 10% gain, you'll only come to 99. You lose 1 rupee there. If you keep doing this again and again and again, think about the statistical equation where you would keep losing if you had initial losses. Of course, you could have a couple of initial gains that would change the story, but that's speculation. You don't have a statistical edge, unlike the casino, where they would protect themselves whether they initially gain or lose. So you need to find a way where you can have a statistical edge, which is legally very difficult. Operators do that all the time because they can control how much they sell and how much they can buy, but you don't do it as a trader and you can't do it legally, which means you need to think about it. You need to think if this is the right strategy for you. So what do I do now? Think about it. You don't need to be a trader. You can get better returns with little effort being an investor. Understanding the fundamentals, doing a fundamental analysis of picking stocks which you understand. If you feel you're that 1% who can do trading and be successful, if you believe in that, then hold on, wait a minute. I'll tell you one strategy which will make a difference to stay above other traders, average traders who make one simple mistake that I'm going to talk about. And I'll have one more strategy as a bonus. So I'll give you 2 strategies which will keep you above other traders. So you come up with a statistical advantage, a meager one, but something that will help you. You keep your upside goal higher than your stop loss and the fair value gain that you had anticipated before you invested. Your upside goal is the amount at which you would sell, that the returns that you demand from that particular trade. Keep it higher than your stop loss. Also, keep it higher than the fall in price. The value that you see has been created. That is the reason why you invested in the first place. You saw some value in it, and that value probably is the fall in price. For example, you saw that there is a repeatable pattern and there is a fall in price, and that fall in price, let's assume it's a particular value. You need to make sure your upside potential, the value at which you would exit, should be much higher than this fall in price. And of course, the stop loss also makes a difference. So make sure the stop loss is smaller than the upside potential. So let's assume that a stock fell from 100 to 90. You think that there is a 10% value being created and you can enter the trade. So that's 10% value being created, and your upside should be more than that. You shouldn't sell it at 15%, probably you should sell it at 20%, or whatever value that you feel is right. It should be much higher than the value that's being created. If the value is 10%, it has fallen by 10%, you could demand 20% to make sure you're over what you would gain. And your stop loss should be 5%, for example. So finally, the value that's being created is 10% and the stop loss is 5%, totaling around 15% of cushion that you have on the downside. On the upside, you have 20%. So that means you have a statistical edge where the upside is more than your downside. And you already entered it at a 10% decline, which means you have a substantial edge. Your stop loss is 5%, your value is 10, and your upside potential is 20%. Thereby theoretically you have 30% on one side and 5% on the other side. Clearly you have an edge. But this edge is very minuscule in practical terms. This advantage can be used if you are able to recreate it for a long time. You need to make sure you are very methodical, and you need to be very cautious here. You need to be methodical, and you shouldn't miss out on your rules. If you have a rule, follow those rules. You need to make sure your statistical edge is intact. With that, you should be able to get a better return trading because you are doing something better than an average trader. But even with this, there is only a tiny advantage that you would be able to beat the market. The best way to beat the market is to be an investor. Works for 99% of the people, hassle-free and very worthy. I have one more strategy for you. The strategy number 2. Never mix investment and trading returns. How many times have you seen a trader tell you that they invested in something which has become a long-term investment for them? A stock that's put into your trading bucket may not be a good candidate for an investment portfolio. So if you make a stock that's in your trading portfolio move into an investment portfolio, you need to ask yourself, is it worthy to be in that bucket? If the answer is no, then it clearly means you made a very big mistake. An average trader makes this mistake every day. They miss to sell it at the stop loss. They feel it could go back again, and finally they realize that it's too low, they can't sell it anymore, and it becomes an investment. So make sure you don't make this mistake to be an efficient trader. So what do I do? I'll tell you what I do. Trading makes the broker, the government in terms of taxes, and the stock exchange pretty wealthy. Once I figured out that the trading effort gets me a very meager returns in terms of effort versus income, I decided to move into investing, value investing, because trading requires a lot of effort. Even with that kind of an effort, you are not going to reap the same benefit as a value investor in the long term. The business knowledge you gain keeps adding on every day. I can't say that for being a trader. There are finite number of opportunities in trading. You can't keep learning. But in value investing, and you learn about businesses, there is a huge amount of information which takes a lifetime to master, and it keeps getting better and better every day. You learn new things in fundamental analysis of a business, you learn new things about a business, and business keeps changing, which means you keep learning again and again, and you become a better and better investor. Your returns keep getting better over time. That cannot be said for trading. I've been a value investor for over 10 years, and I will never go back to trading. That's me. What's your opinion? Put that in the comment section below. If you feel trading has really helped you, tell us about it. Value investing and a keto diet has changed my life. Tell us what changed your life in the comment section below. And don't forget to subscribe to my channel, and bye-bye.